Hello everyone, on this week's Cytonn weekly report episode, we focus on Kenya's fixed income, equities and real estate market for the week ended, and with a special focus on Kenyan currency and interest rates review report for 2026. Joining me, a key analyst from Cytonn, together with me, your host, Christopher Magoba.
Hello everyone, my name is Malcolm Roten, an analyst at Cytonn Investments.
Hello everyone, I'm Derek, an analyst at Cytonn Investments.
Hi everyone, I'm Ivy, an analyst at Cytonn Investments.
So focusing on the fixed income market, what does the continued oversubscription of T-bills, especially the 364-day paper, tell us about investor confidence and interest rate expectations?
Thank you, Chris, for that question. Looking at the oversubscription, the thing it communicates about investor confidence is that most investors are confident about the government securities. That's why they're rushing and oversubscribing beyond the offered amount. And then the expectation on the interest rates is that whenever you see an oversubscription on a specific paper, especially a 1-year paper, there's a feeling that among the investors that the interest rates have peaked. So everyone is in a rush to capitalize on the peak interest rates before they start coming down. So that's why there's an oversubscription on the paper.
So another feature this week is the recent cut in CBK rate and falling inflation. So would you mind explaining the downward momentum or movement in yields on government securities?
Yeah, so if you look at both aspects combined, if you combine the lowering of the MPC rates and the declining inflation, the two aspects in both on an individual level normally apply a downward pressure on inflation, on interest rates, not inflation. So the lowering of the CBR rate normally indicates that now people can borrow at cheaper costs, and most people who are lending, they're not demanding a lot from the borrowers. So the government in this case is the borrower. So if the CBR rate has come down, then it means the government is not going to borrow at a high rate. Then when we look at the inflation, the impact it has on the interest rate is that when the inflation is low in an economy, the real return also comes up high. Whenever inflation goes up, the real return becomes lower. So if the inflation is low, the investors will not demand a lot of returns from the government. So the yields will go down.
So moving on to the equities market, why did the banking stocks drive most of the gains in the market this week, despite large caps recording losses?
Thank you, Chris. The banking sector have heavy index weights. Like during the week, we had strong rallies on the Diamond Trust Bank, Stanbic and Equities, recording 18.1%, 16.8% and 12.19% respectively, which offset the losses made by few large cap stocks like the NCBA by 2.7%, making the banking sector, the market go higher. Also, in addition to that, the investor sentiment toward the bank remained positive due to the resilient earnings, attractive valuations, and the expectation of stable asset quality, which encourages the buying interest, which outweighs the losses made by the large cap stocks.
So on this week's focus of the week, the Kenyan shilling remained stable in early 2026, appreciating slightly to 129 Kenyan shillings per USD, supported by higher forex reserves, increased remittance, and improved macroeconomic conditions. So question number one, what factors have contributed to the stability of the Kenyan shilling so far in 2026?
Thank you, Chris, for that question. So there are many factors that normally contribute to the stability of the Kenya shilling, but I'll highlight a few of them. So number one is the increase in foreign inflows. So for instance, the diaspora remittances in the 12 months leading to January 2026, we see an increase of 1.2% in the diaspora remittances to 5.2 billion. That is not the 12 months to 2026. Also, another attribute I can attribute it to the narrowing of the current account deficit to 3.2% in Q3 of 2025. So the narrowing of the current account deficit reduces a demand on the foreign exchange, which in turn leads to the appreciation of the shilling.
How has improved credit ratings and falling Eurobond yields reduced pressure on the local currency?
Thank you. So on the improved credit ratings by various institutions such as Moody and Fitch, this normally leads to improved confidence by foreign investors, since once the credit rating of a particular country has been revised upwards, we see that now foreign investors are confident that the country may not default on their bonds that they issue to the foreign investors. So on the part of the reducing yields of the Eurobonds, the borrower, being the government, will be at an advantage in that particular issue since if the yields of the Eurobonds reduce, that means the government will pay less in interest to their respective creditors. That's not the foreign creditors who buy the Eurobonds that the government normally issues. So factoring the two in mind, they will in turn lead to the reduced pressure on the Kenya shilling in general.
Thank you very much for joining us on this week's episode. You can get the full report by clicking on the link in the description box or by visiting the cytonnreport.com website to get out the full overview of the report. Thank you very much.